Tai Hui, who's the Chief Asia Strategist at JPMorgan Asset Management, joins us from Hong Kong. Good having you. Thank you so much for joining in. First, that top-down approach. Great rally for India YTD. How do you stack it up versus the rest of the pack that you may be tracking? And what's par for the course for the next, say, 6 months?
Well, I think India's clearly been a strong performer year to date relative to the rest of the emerging markets. And for good reasons. I think the change in the political landscape has been a huge supporter or a huge catalyst to the Indian. And also, beyond politics, we are seeing a gradual turnaround in the economic cycle, and that to us is another big positive for the Indian markets. I think looking ahead, clearly there are some uncertainties. For example, the pace and aggression of Fed's normalization. And domestically, how does the inflation play out? How does the new government continue with its economic reforms? I think those are key questions that I'm asking in terms of the outlook of India. But overall, I would say we have a pretty encouraging outlook for the Indian market over the next 6 to 12 months.
You know, a big talking point this morning is the dollar index now at 85, and it's quite clearly broken out almost at a 5-year high, and that's going to create havoc for emerging market currencies such as INR, which is pegged against the dollar.
Well, I think if you look at the emerging markets, you're absolutely right. We've had a bit of volatility in the month of September, and that's partly due to the dollar index, but also, I think more importantly, a resumption of the rising treasury yield that we've seen. And the reality is I do expect the US dollar to be in a multi-year uptrend on the back of its monetary policy, but also improvement in its current account. The good news, I think, for India is that if you compare Indian rupee with the likes of Brazil, Turkey, or South Africa, Indian rupee has been actually relatively stable and resilient, and I'll credit that to the good policies done by the RBI in the last 12 to 18 months. So while I do think the dollar is likely to strengthen against emerging market currencies, including the rupee, I don't think we are likely to see a repeat of 2013 where the taper tantrum created havoc in the emerging market currency markets.
Now, you know, internally within India, I mean, it's been a few months that the new government is at the helm. There have been a few decisions which have been taken, small ones, and a couple of large decisions have been postponed till now for better clarity maybe. How are investors viewing what's happened over the last 3-4 months, and how does India stack up internally with all that's happening politically?
Well, I think international investors still view India very favorably despite some of the, slower than expected implementation on big policies. At the end of the day, you should not be expecting a government coming in with all guns blazing for the first couple of weeks and announce big policies. There's a lot of consensus building that needs to be done, and clearly Prime Minister Modi has been very busy with the international schedule. And all that, I think it's important to, first of all, really explain to international community what these policy stance are, and meanwhile, gradually change some of the policy landscape in India. The reality is there are some low-hanging fruit in India that can be done. For example, clear out some of the legislation or the legal cases. It's been bogging down the business sector, but there are some tougher decisions that require a stronger public support, public mandate, and that's going to take time to build. So I think we're very much on track to what we expect to see from a new government with a strong reform mandate. I don't think I'm disappointed at all with the new Prime Minister.
I want to talk about the U.S. economy because data points definitely are beginning to look up. The U.S. home sales have come in at a 6-year high. Does it seem like the equity rally, at least for Wall Street, is going to stay put?
I think so. I think if you look at the U.S. market, it's been doing reasonably well, albeit not as strong as 2013, but certainly within the high single-digit, low double-digit return that we expect to see from the U.S. markets. And I think the reality is it's also starting to spill over into emerging markets because at the end of the day, U.S. is still the biggest economy in the world, and it is going to buy from many emerging markets. So in that sense, our call for equities to the allocation be gradually increased over the last 12 to 18 months has worked out reasonably well. And at the same time, that's pushing the Fed to continue with its own normalization, which means the fixed income market in the U.S. market is going to face more headwinds, and that will force also more capital to leave the fixed income market into equities.
Okay, Tai, we'll leave it at that. Thank you so much for taking the time out and joining us and giving us that perspective. Really good having you.